Mish Snyder is joining us this morning, Chief Strategist for Market Gauge, and always great to talk to you, Mish. How you doing on this volatile week?
Pretty good. There's a level of patience you have to have. It's really hard when you start to see all the emotional reactions to the market. I mean, it happens when it's going up and then it happens when it's going down. So I try to step back, look at some multiple time frames, and that kind of helps my head a little bit.
Yeah, I was just going to mention that because obviously with the shorter term trading, we look at the 15-minute and the 60-minute, and I like to keep the daily and also to give you the monthly perspective on things. But let's go a little bit macro here.
Okay.
I mean, did Powell give us any new information on Wednesday? I mean, am I sleeping here? What's your perspective on what happened on Wednesday?
What was more surprising to me was up until Wednesday, how the market really believed that we were going to see rate cuts anytime soon. So I think what happened was that he just reiterated for the, I don't know, umpteenth time what his intention is, which is really to keep rates higher for longer until he's 100% convinced that things are somewhat normalized. And that's an interesting point because if everything ended right now, we would have CPI and Fed funds pretty close together, which is somewhat of a normalization. Do people like higher interest rates? No. But in terms of history, having 5 to 6% Fed fund rates is not abnormal. Zero is abnormal. So that's kind of what he was saying is like, all right, I'm not looking at the soft landing. I'm looking at normalization, and there's still threats. So at this point, we are not planning to do anything in terms of cuts. And that's what the market heard. And all of a sudden, people went, oh, my God, he's not cutting.
All right. Having a family, you know that there's some people that behave and some people that don't behave, right? And what I love about interviewing you all these years, if you've had the modern family, you've had the sectors, these areas that you've focused on, very broad, covering a lot of things. And I would have to say the one misbehaving the most in the modern family is the IWM. So,
Grams.
yeah, Graham. So go ahead with that.
Well, I wasn't watching, but I heard, and I think it was you, Mitch. Before I did, I just don't want to forget to mention something about the whole idea of the wages, and you were talking about Tesla, and we'll get back to Gramps in a moment.
Yeah.
But I thought it was such a good point what you were saying about Tesla, because really, in terms of the macro, I had been pretty convinced that our inflation was going to come out of energy as an X factor we talked about, and food, and certainly all of that has played out. We have a big USDA report coming up next week, and I think that will give us a better clue in terms of our own crops here in the U.S. And of course, we still have very, very bad drought in Argentina. But to me, the biggest focus for inflation right now is this whole idea of wage inflation. And that's why before I get into this, I just had to really recognize what you said, because to me, the backdrop is with the UAW strike and even the writers' strike, which looked like it was going to end and it really hasn't. We have a mood now, not just globally, but in this country, that people want more. And that is, to me, a very inflationary scenario, whether wages increase or not. Because if they increase, obviously that's inflationary for, the reasons of the fact that companies now have to produce less in order to pay these wages. And of course, that means supply demand gets skewed. And if they don't get the wages that they want, then I think we get a different type of undercurrent of almost like a revolution in a sense. We've seen shades of it, right, with quiet quitting and not refusing to go back to the office, et cetera. So it's just something to keep an eye on. I think that could be a real theme as we're going forward. So sorry for the diversion, but
I think that's a great comment. I think that also leads back to kind of what Joel's been talking about, that maybe we never even get back to that 2% and we have a new normal of inflation. And a lot of that could be due to the wage inflation, right? And so let's go ahead. Let's take a look at the IWM. Let's take a look at Gramps and see how it's looking. I know I was stunned to see it. It's almost right back to the 170 area. What are you seeing, Mish?
Well, it's so interesting because you mentioned the monthly time frame, and I started out this year and I looked at the Russell monthly chart. I thought to myself that it could even take out a 2-year moving average and go up to around 200 if you're looking at IWM. And if it didn't get through that point, that would be the top of the market. And so far, that's turning out to be the case. So if we look at IWM from a more fundamental standpoint, of course, there's a lot of stress there. That's really the manufacturing side of the U.S. economy. These are small cap companies that produce within the United States. And it works hand in hand, right? That's why they're married with grandma retail, because as consumers have been feeling the pinch, obviously we're seeing the pinch in a lot of these big companies that are in the basket of the small caps. So at this point right now, we're back under that 2-year cycle, but we're still okay until we get down below 160. And the way we'll know if we get below 160 is if XRT breaks 57. So the best we can say right now, you said, bring me something good, right, Joel? The best thing we can say right now is volatility rallied right to resistance, that we still have the S&Ps and the NASDAQ above that 2-year business cycle, and that XRT and IWM are very close to major support, and the risk factors that we like to watch are still risk on, risk neutral until you look at gold versus silver. Gold is starting to outperform. Gold versus SPY, excuse me. I have silver on the brain too. Gold versus SPY, because gold is outperforming, and that's always a warning. So getting back to IWM, it is possible. And did you see this statistic by Ryan Dietrich, by the way?
Oh, no, give us to it.
Which one? But Statman's always good.
This morning, I think I retweeted it, but yeah.
Yeah,
Let's
so he said
it.
Since 1981, every time we've had a negative August and September, 9 times out of 9, the market has gone up in the fourth quarter. The average rise 9.1%. And I thought that was really interesting because September is always a bad month. I shouldn't say always, but very typically a bad month. So it is possible if we, but if they have somewhat of a normalization, if the whole rate cycle now is topping out, if the inflation goes up and it's more wage in force, of course, we'll start to see things like the precious metals go crazy, and they've held very well. But if we can kind of hang out here and people get adjusted to the way things are, it is possible, via Ryan Dietrich's comment, that we might actually see some buyers coming back in. And that's the best thing. But if Granny, retail or XRT, as I say, Granny, breaks under 57 and the Russells break down under 160 IWM, then we start looking more recessionary, and then we can have a completely different conversation. But for now, I'm going to try to stay relatively optimistic because the risk is neutral to on.
All right, let's talk about an area that I've been trying to point to. It's just sign of concern. The KRE, the banks, the regional banks really starting to show. I could see kind of like a head and shoulders that had already been showing. Now it keeps coming back to those old kind of resistance lines and trend lines from where it was before the regional bank concern. Are we going back to this concern?
No, I don't think that the concern ever went away. It just got put on a back burner. Yeah, the commercial real estate space obviously has been a big stress on the regional banks. That's part of it. And of course, after March, we had a nice bounce from there, but it wasn't extremely impressive, was it? We had more of a technical bounce and, like I said, more of a relief rally than anything else. I don't think anything has really changed within the banking system. And of course, we could have some major credit event. There are other people who are calling for that. But in my mind, this whole banking situation is evolving away from traditional banking. And that may not be the worst thing in the world, number one. And I'm going, obviously really far out here. But number two is, it seems to me that in the digital world where we're going, that really opens up the space for more in terms of Bitcoin. And so I still think the long-term view for Bitcoin is very bullish.
Okay, Mish, so let's talk about someone that's behaving a little bit better in the modern family. And I guess if we would have talked about this 2 weeks ago, it would have been this, some of the semiconductors, right, with NVIDIA leading us back to a new all-time high. Are you looking at this as just like a peak cycle, kind of like your Cisco in the early 2000s, or are you looking at say, hey, we need those chips for the AI? This is you're raring up for buy the dip. I got the SMH up here, but
Yeah, I see.
talk about the recent price action in the semiconductors.
Well, you want to talk about emotional trading and things getting too rich, and also the relationships getting very stretched between, let's say, something like the Russell versus the semiconductors, or if you want to call it the value versus the growth. Those ratios can never last too much. In terms, again, of the fundamental future, yeah, of course, AI is the future, and of course, chips are going to be required. But let's look at NVIDIA as a perfect example. It's run up after the earnings to over 500. That to me, that was what that stock was worth. So I wasn't surprised to see selling coming in. Now we're closer to the 400 level, and we'll see. I think you have to be very long-term positive in there, but from a shorter-term perspective, what could actually crack the whole market would be if that continues to fall. Right now, it's still well outperforming. And looking at that chart that you just put up there, the one on the top right, which is the NVIDIA chart, we're still holding that major gap from May, June.
Yeah.
And so, we have room. There's room to the downside. It's a matter of picking the point. What's the point that's going to be the point to buy NVIDIA? Is it going to stop at 400? Could it go back down closer to that gap low at 360? Yeah, I think we're in there right now. 400 would be a good place at least to start if you're a short-term trader. We still own some NVIDIA from our quants. We took profits, obviously, but we still have a position because they use a wide range trailing stop after we get traction, and we bought it down around 250. So, it's really going to be a matter of the next couple of weeks as we get through September, if indeed, going back to Dietrich, we're right, and we start to see buying coming in, NVIDIA will certainly benefit from that, and the whole growth area will.
Surely haven't been talking about the biotechs at all. I mean, of course, higher interest rates, they need money to, to fund the trials and everything. What a horrible 2 days here for this. And this is it's been bad news here. We just don't talk about it. And I mean, it's like, I can't remember the last time we talked about like Biogen or actually Amgen's held up a little bit better. You combing the ditches here. Oh, look at that Amgen. Amgen's strong. Yeah.
Right.
Combing the ditches here in the IBB.
Well, another member of my modern family, right? So the whole biotech space has just been in this giant consolidation, and it broke down below the 124 level yesterday. So that was a little concerning. But right, it's almost like you have almost like the Magnificent Seven in the overall stock market. You have the few drug companies that have done very well, Amgen, Vertex being another. Yeah, I mean, it's a cyclical and a non-cyclical area, the whole biotech space. So like you said, it's going to feel stress from higher interest rates. At the same time, it's something obviously that people need. And now with the new COVID thing, whereas that gave a real big boost to the market in previous COVID scares after obviously the initial one, now people are kind of like, I'm not even going to bother to get a vaccine. And I think that's hit the bottom line. And yet there are certain companies that are still doing okay. We've actually been in Teva Pharmaceuticals, and we've rode that up, and that actually is consolidating over 10 if you put that up. So I think you just got to pick and choose your places in that space. And this is one that we like a lot. I mean, if you look at that bottom chart there, which is that monthly chart, we just got to get up here a little bit higher. It looks like we're working there. And there's no reason why this can't go up to around 15. Do I think this is going to go back to 70 where it was in 2015? Well, I doubt it. But we'd be happy riding. We got in at around 850. Getting up to around 15 would be almost a double. That's kind of how you have to play these sort of weaker stocks.
Mish, I want to get your thoughts on XBI specifically in relation to KRE, and what we saw back when we had the regional banking issues is that the XBI became linked with the KRE. I think the reasoning for that is a lot of, smaller biotechs are very dependent on credit, and we were worried about credit tightening when the banks were all having problems here. KRE is coming down substantially from the highs. We're now $49, ugly head and shoulders happening here now. We're not that far from, July lows here when we were on 39. We're a little ways off from the lows that we were making back when we all thought all these banks were going out of business back in May when there was 34. But are you concerned at all of the weakness, one, in the banks, and then obviously XBI just seems to be following suit?
Yeah, well, somebody asked me recently in an interview, it was charting forward, what would be the two areas to avoid in the market? And I said, China, which is obviously not U.S., but China, the whole China space, and the financials would be the other. And this is the reason why. This is a big shakeout right here, and everything is shifting. That's why I said the optimistic side is it's evolving into something completely different. And at some point, these commercial real estate areas will figure out another purpose for it. We don't know. Obviously, there's a shortage still of housing, and that's why we've had construction doing much better in terms of the new construction versus the existing home sales. We've seen that kind of spread. But it's interesting. Will this ultimately impact the market? Again, if we have a major collapse like, a 2008 collapse, but this is where the Fed comes in and kind of tried to save the day in March. And I don't think they're going to let this, the too big to fail. I still believe that, and this is why I'm still in the inflation camp. I still think that the Fed is willing to put dollars to prevent this sort of crash from getting out of control.
Mish, I just one final thing for you. Many people are calling for the commodity super cycle of super cycles. And, like, woohoo, everyone's going to own commodities. Crude, you can't argue with the move in crude here. I'm looking at some of the other commodities. If I look at corn, well, I don't see no super cycle there. I look at wheat. I don't see no super cycle there. I look at sugar. Or that soybeans, beans have held up. I know there's some USDA reports coming up, but is a commodity super cycle that will just give us rapid inflation and crush the economy on the horizon?
What a great question. Well, okay, so historically, from 1974 to 1976, we had this peak in inflation in 74. That was after the whole Six-Day War and oil embargoes, and everything went crazy with the oil prices, brought inflation skyrocketing and CPI up to around 14%. Or maybe it was like 11% at that point. Somewhere between 11 and 14. Sorry, it's still very early in the morning, so I'm picturing the chart, but I can't see the number. And then we went all the way down in CPI at 76. We got into a recession, down back to around 2%. And then in 76, things started to spike up again, partly because of oil. And then it spiraled. We had a lot of social unrest in the country. I started thinking about Spike Lee's film, Summer of 77. We had strikes at that point. We had, protests on the Vietnam War. We had a change of administration. Our inflation president, Carter, came in. And so all of this really went from we're done with inflation to a next super cycle. And I think that's why we're looking at the comparison, because history rhymes, right? Doesn't necessarily always repeat to what's happening here. So we had the spike in 2021, kind of peaking out in 2022. And here we are entering 2024. It's possible that we get another rise. And what would cause that? Well, there's so many reasons why we haven't seen them yet. So just looking at the charts like that, to me, the wage inflation and, like I said, the social unrest is maybe number one on my list. Obviously, oil and geopolitics would be number 2 and 3. So yeah, I'd say it's possible. But instead of trying to guess, look at some of these relationships. Gold outperforming SPY is 1. Silver, all of a sudden yesterday went green, which I thought was really interesting because if it starts to outperform the gold, keep your eye on those oil prices, obviously. And that's really what you're going to have to look at right now is what kind of inflation cannot be controlled so readily. And it would be the kind of disruptive to society type of inflation. I'd say short of that, I've calmed down on my super cycle, but I still think it's very possible. Look at gold. I mean, it's just holed up like a rock. So that's kind of telling you that all is not necessarily well in the world.
Mish Snyder, Chief Market Strategist at Market Gauge. We haven't done any floor stories in a while. I'm going to save that for next time. But
Okay.
just such a pleasure covering so many different things here and so many things that go into this market. You do a fantastic job of putting it together. We'll be dialing you up again real soon. Thanks, Mish.
Thanks, Joel, Mitch.